We had a fairly strong week in the S&P 500, green right across the board, although we did see some notable companies down, like Alphabet, like Amazon. But one thing we need to be wary of in the market right now is that the forward P of companies on average are trading around 30.52. Now that is pretty high. Typically on average we see it around the 20s, but for those that want to know, in the Great Recession we can see it was more than 100. Things to bear in mind, but again, just something we want to draw to your attention today. Now this episode we are focusing on 6 undervalued Dividend Kings to buy and hold forever. Now the reason why we do like Dividend Kings, and for those that don't know, effectively it is a special status giving to companies, and now they have had to have raised their dividend for at least 50 years on a consecutive basis. And why is it that makes them so attractive to investors? Well, as we can see, typically we believe it means they've survived everything. This is going from economic recessions to major technical advances. The information that we are looking at right now is from our free weekly newsletter, which you can sign up by clicking on the pinned comment below. Why is it that we like to look at companies that pay out dividends, especially Dividend Kings? Well, from 1930 to 2020, so a significant period, the S&P was made up in terms of total returns 40% purely from dividend income. And if you want to see the graph here, you can see in terms of the dividend income, some years it is very, very high and some periods it is fairly low. But the average makeup of this, as we can see, is 40% purely from dividends. So that is why we do like to focus on dividends, especially as we go throughout today, going through these Dividend Kings. And another graph for those that want to see the S&P, so we're looking at a different period. This is the more recent 20 years, 43% of historic return due to dividends and the compounding effect of dividend reinvestment. So just reinforcing the fact that the companies we are looking at today do support the thesis that Dividend Kings are great opportunities if you believe in them over the longer term, if they do fit your overall portfolio. The final thing we're looking at before we are jumping into the companies today is that the returns of the S&P index stocks by their dividend policy, pretty much taking $100 invested over time. The one that strikes the most are those that are dividend growers and initiators. So for example, companies that have recently started to pay a dividend. Companies that come to mind, we have Meta Platforms this year, we have Alphabet, I believe also Salesforce. Then coming in second are just those who pay a dividend, and then we can see the others. In fact, no surprises, right at the bottom we have dividend cutters and eliminators. So these are just essentially highlighting why we like to focus on Dividend Kings, which is the basis of today's episode. Now we're going to look at 6. We're going to jump straight into the first one. Needs no introduction. It is the Coca-Cola company. Now we get a buy rating from Wall Street, we get a hold from both Quant and Seeking Alpha, and this one has had a pullback, especially over the more recent period, trading in the mid to lower end of the 52-week range, a nice forward yield just over 3% at 3.04, and a forward PE 22.4, well below the average of the S&P as we showed you earlier on. Over the last 12 months, well, up 9.4%. Over the last 10 years, up only around 43%. That has underperformed the S&P over the last 10. But bear in mind, if you do reinvest those dividends, your gains would be higher. Now, in terms of their earnings, nice to see over the next 4 quarters, they are anticipating growth, each one, to the EPS year on year. And they've also, at a bare minimum, been in line and in fact beaten over the last 4, giving them a 100% track record. Now, if they hit their EPS for the next full year at 3, their forward PE will come down, in fact, to around 21.32. Looking at dividend safety, very important in today's episode. We are talking about Dividend Kings, companies that have increased dividends for 50 years or more. Coca-Cola, well, 80 safe. We'll run through these 2 models shortly, and we can see an above inflationary increase February this year at 5.4%. Remember, 4% is the bare minimum we want to see, as the US inflation rate over the last 40 years has been at that level. If you're getting anything less, whether that's your dividends, your salary, or other income producing assets, you're in essence taking a pay cut and losing purchasing power. Now, dividend safety score was reaffirmed at the beginning of this month, and what this ultimately means is that a dividend cut for Coca-Cola is unlikely. Now let's take a look at some key metrics. We'll look at this for each one of the 6 today. This is essentially how they performed in the 07-09 recession, the big crash. Well, no surprises, Coca-Cola and each one of these will have increased it, as we said, 50 years or more, and they have above average growth during the period, -5%, S&P itself was -12, and they also significantly outperformed the S&P in terms of return, -31, S&P itself, -55. As we mentioned, above inflationary increase in February this year, marginally lower on average over the last 5, but when we zoom out over the last 20 years, Coca-Cola has been increasing those dividends at 7% on an average rate. Now, 61 years of consecutively increasing the dividend, but on top of that, they've been paying a dividend for the last 104 years without a reduction. Now we get to the first valuation model. When we zoom into over the last 12 months, blue tunnel telling us the expected fair price. For Coca-Cola right now, it sits in the middle. This is what we would classify as reasonable valuation. But again, remember, we're not looking at any one of these models in isolation. We will conclude towards the end of each metric analysis. Now, dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year average. For Coca-Cola, pretty much in line, so we would classify this as a reasonable valuation. Forward P, though, right now of 21.9 is lower than the 5-year rolling of 24, so that is an undervaluation signal. And we notice it is trading above the consumer staples of 18.5, therefore meaning it is trading at a bit of a premium to the overall sector. In terms of free cash flow payout, as always, we draw your attention to free cash flow over earnings on this channel, which is susceptible to manipulation by management through accounting. Below 70% for consumer staples, reason why we have these targets, so we have faith management are able to offer us nice dividend increases. Now, it's been straddling above that, in fact, every single year, 82% in 2023, expected to go 103% over the next 12 months. Now, this is one reason why we focus on free cash flow, not something we'd be able to ascertain from looking at the earnings ratio. This tells us anticipated over the next 12 months, management expecting to pay out more in dividends than generating in free cash flow. A little bit of a red flag indicator for us, something that we do need to keep our eye on moving forwards on a quarter by quarter basis. Now, free cash flow per share, typically we want to see consistent increases over the longer term. And whilst we do get the increase from 2014 to 2023, it is very inconsistent and a drop is anticipated over the next 12 months. Again, it is important to understand what type of company you are looking at. This isn't a fast growing company, a tech for example, where we do anticipate massive double-digit growth year on year, but at the same time, at the bare minimum, we do want to see some kind of growth. Now, in terms of sales growth, we don't actually get the increases over the longer period that are sustainable. We actually get 6 of the last 10 years being negative. Remember, 3 to 7% is what we want, 3 to 4 at a bare minimum just to keep up in line with inflation. What is nice to see though, over the last 3 years, we are getting growth on a more consistent basis. 3% on a trailing 12 month, telling us that hopefully for 2024, when they announce their full year accounts, at a bare minimum, they have been keeping up in line with inflation. Now, total sales, this is just the numerical format of what we saw above. And shares outstanding, we draw your attention to this because what we want to see on top of nice dividend growth are companies returning excess cash to shareholder pockets through those share buybacks. We've seen Coca-Cola do it all. They've issued shares, they've also bought back shares, but over the period, very, very minimal net share buybacks, so not too much to discuss that, and ultimately probably not a priority for management in terms of their capital allocation. ROIC, one of our favourite metrics, 10% or more, 12 for consumer staples. Give us faith, management are able to effectively allocate their capital, and we can see this increasing year on year and above the minimum threshold, 18%, 23, 18% on a trailing 12 month, no worries whatsoever. Now, operating margin, what we want to look for here is above the minimum, we can tick that off, above 16% year on year, and operating efficiency with margins increasing. Again, you could argue it has done that over the longer term. Nice to see 30% on a trailing 12 month, and free cash flow margin looking very strong, double digit year on year, so no complaints with Coca-Cola and their margins overall. We then move on to the final metric, net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization. Below 4 is what we want for consumer staples. That is what we get. And the numbers below, for those that are new to this metric, show us the number of years it would take the company to pay off all of their debt net of cash on hand. And why we focus on this metric correlates to both dividend safety, balance sheet strength. What is good to report from the highs of 2020, 3.03, it has been coming down again on the trailing 12 month, down expected over the next 12 months. So dividend safety score was 80, does look to be safe, and balance sheet based on this metric also does look to be secure. Now let's jump into the valuation model for Coca-Cola Company. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now how we got to our intrinsic value of $68, it is the average of these three models. Now when we do our deeper dives on this channel, we do run through every single one, talking about the inputs and outputs. Today we're jumping straight through it, $68. What we typically like to do is add a margin of safety, 10% where we execute on that if it meets our three golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today for KO, well, a buy at around $61, not at that price yet, not too far off. So we do believe right now, if you are buying, you're getting a 5% MOS for a Dividend King. Some people though will want to see 10%. Some people may even want to see more. At 15%, $58. At 20%, around $54. But whilst we believe it only has a 5% MOS, Wall Street very bullish. They see a price target $76 to be hit over the next year, with upside of 19%. As always though, give us your thoughts in the comments below whether you have been buying these Dividend Kings, whether you hold them in your portfolio, or maybe you're holding or considering selling. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, so a new one is coming tomorrow, where we talk about severely undervalued stocks that deserve your attention, as well as what's gone on in the market over the last few days. So click below, sign up, and you can start reading straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, upside that Wall Street themselves see over the next year. And on top of that, we have just released this week 29 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, sign up, and you can start reading straight away. The next Dividend King, we have Johnson & Johnson with a double buy rating, a hold from quant. This one's trading in the mid to lower end of the 52-week range, a forward yield above 3% like Coke at 3.2, a forward P at around 15.6. Now over the last 12 months, up only 3%, over the last 10 years, up around 43, and when we take a look at their earnings, it does look to be a little bit topsy-turvy. Out of the next 4 quarters, only one of them they're anticipating growth, but great to see out of the last 4, they have outperformed management targets, 100% track record, and they also believe growth is coming over the next 4-year accounts, 10.63 with the forward P coming down to 14.6. Now we get a dividend safety score of 99, very safe, the highest score obtainable, a double severe undervaluation signal, and an inflationary increase this April at 4.2%. Now it was just reaffirmed a few weeks ago, and for those that want to know, very safe means that a dividend cut is highly unlikely. How do they perform in the last recession? Well, again, no surprises. Each one of these today will have increased during the last recession, as they have been paying increasing dividends over the last 50 years. Above average growth, -6%, and massively outperformed the S&P, -27%. Now we notice here above inflation in April this year, but 6% and high single digit 8% over the last 20, which is great to see. And not only 61 years of consecutively increasing the dividend, but they've been paying a dividend for the last 108 years now without a reduction. Moving on to the valuation metric, pretty much for nearly the last year, this company has been trading at severe undervaluation levels, possibly a good time to accumulate, and we can see massive undervaluation. Yield is well above the 5-year rolling, and the forward P of 15.4 is below the 5-year average of 16.5, but it isn't too far off the healthcare overall sector at 15.7. In terms of the free cash flow payout, below 60% is pretty much what we get for the majority of the years, bar the last 2. Great to see over the next 12 months coming to around 61%. We then move on to the free cash flow per share, where we get inconsistent increases, but nonetheless moving in the right direction over the last 10, and a nice growth jump is anticipated over the next 12 months. In terms of sales growth, 2 of the last 10 have been negative, but the last year is looking good at 6%, as well as on a trailing 12 month at 5%, meaning in 2024 we anticipate above inflation increases to the top line sales. Then we have the numerical format, as we can see here, And one thing they do, maybe not as consistent as you want to see, are those share buybacks. In fact, we do see more than 10% of those bought back from 2014 to the latest quarter, where it sits at 2.43 billion. ROIC, no complaints whatsoever, 23% in 2023, 21 on a trailing 12 month, always good to note. And we can see margins also looking fairly impressive, very consistent. Yes, we don't get efficiencies, nonetheless nearly 28% every single year. And free cash flow, given how consistent this is and how high these numbers are, you could argue Johnson & Johnson is a free cash flow machine. On top of that, we do love to see the net debt to EBITDA as low as possible, 0.25 in 2023, anticipated to go up over the next 12 months, still well below that. No surprises then why we did see that very safe dividend score, and definitely one that we do like overall. In terms of the valuation, $179, not far off Wall Street, 178, where they believe 15% upside over the next year. And in terms of MOS, 10% at buy at 162, at 15% at 153, so really not far off. Dividend King, 15% MOS, 15% upside, and for those that do want to know, at 20%, $144. As always, give us your thoughts below, buy, hold or sell for J&J. We then move on to Stanley Black & Decker, where we get just one buy rating from Seeking Alpha, a double hold from Wall Street and Quant. This one is trading towards the 52-week lows, another yield above 3% at 3.68, a forward P of 21.5. Over the last 12 months, well, pretty much minimal movement, looking flat. Over the last 10 years, this one is down around 5.5%. We can see all-time highs around $220, and we're talking more than 3 years ago. When we look at the expectation, well, very, very impressive. Double-digit growth expected every quarter over the next year, and they've also outperformed over the last 4. That is a 100% track record with massive growth anticipated over the next full year, bringing that forward P all the way down to 15.92. Now, we do like this dividend safety score of 80, as well as the double severe undervaluation, but as you already will know by now, very disappointed in the 1.2% increase in July this year, very likely just to maintain that Dividend King status. In terms of how they formed, last recession, we'll just keep highlighting it, but increased average growth, although remember that was -12, and a near S&P return, -58. Now, historically, they have been increasing those dividends at above the inflation rate, and we can see here 56 years of consecutive increases. I think this is the highest we've seen so far today, 147 years of paying a dividend without a reduction. Now, in terms of the valuation metric, over the last 12 months, we notice now for the first time it is out of the blue tunnel, an indication here of severe undervaluation. That is also reinforced in both dividend yield theory as well as the forward PE, and when we do take a look, it is also trading at a discount to the overall industrial sector, so Stanley Black & Decker is giving us massive undervaluation across many, many metrics. In terms of the free cash flow payout, below 60%, very, very inconsistent, but nice to see in 2023 and over the next 12 months under that maximum threshold that we have. Then we move on to free cash flow. A lot of inconsistency, something we have noted with these Dividend Kings so far, but growth is expected over the next 12 months. And then we move on to the sales growth. Now, out of the last 10 years, 4 and notably 2023 have been negative, which is when we do zoom out, we can still see around 40% growth from 2014 to 2023. Again, very, very similar to the previous Dividend King, those share buybacks as well as share issuances, but the net effect is around 8% of buying back those total shares from 2014. ROIC above 10%, we got that pretty much every year until the last 2. What is good to note is from the lows of 2023, the essential trailing 12 month are showing signs it is heading right back towards that 10% level, sitting at 7% currently. Operating margin above 12% last 2 years, again pretty much mirroring the ROIC, down to 4% in 2023, up to 7% on the trailing 12 month, and then when we get to the free cash flow margin, straddling around that 5% minimum. Net debt to EBITDA, massive worry. Just look at that increase from 2020 all the way up to 2023. What is great to see here, I do like this company in terms of the metrics and how they are able to turn things around. Over the last 12 months, it now sits at 4.08. Over the next 12, they are expecting to bring this down. So this company does have some very promising metrics, as well as some things we do need to ultimately consider. Our intrinsic value today, $100, which means you are getting a 10% MOS at today's price. For those that want to see 15%, buy at 85, at 20% around 80, and at 25 around 75. So we see 10% MOS, Wall Street themselves bullish as well, $104 price target with upside of 16%. Remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for SWK or any others. We then move on to S&P Global, a fairly new dividend king with a strong buy from Wall Street, a buy from Seek Alpha, and with a hold from Quant. This one is trading at the upper end of the 52-week range, a forward yield on the lower end at 0.71%, a forward PE of 34 on the higher end, and over the last 12 months, well, up 24%. Over the last 10 years, massive outperformance of the S&P, up 451. We also notice positivity in terms of growth over the next 4 quarters. However, out of the last 4, they have outperformed 75%, although good to see that the miss was 4 quarters ago. With no surprises, growth anticipated over the next full-year accounts, lowering the forward PE to 30.6. Similar to Johnson & Johnson, the high score obtainable at 99, and we do also note a very, very poor increase to the dividend at 1.1% in January this year. Now we can see here the increase 07-09, and they did have below average growth at negative 38%. Nice to report, even though they had a mediocre increase this year, 12% over the last 5 and 10% over the last 20. As we mentioned, 50 years of consecutive increases, so only recently did they gain that very special status. In terms of the forward P and the valuation, well, over the last 12 months, it has been trading at the upper end, something we do still see now, hence why it was given that reasonable valuation. And when we get to dividend yield as well as the forward P, you could argue slight overvaluation / reasonable valuation. They're both not far off the 5-year rolling averages, but this company does trade at a massive, massive premium to the financial sector. But you know what? Within this bucket, there are some very poor quality companies. And whilst we don't know how much of a premium just yet this company is worth, we do believe ultimately S&P Global is a company worthy of a premium. Free cash flow payout below 60% pretty much every single year, 22% on the trailing 12-month and anticipated over the next year. Whilst we don't get consistency, nonetheless, it has increased very rapidly, threefold over the last 10, and a massive growth jump is expected over the next 12 months. In terms of sales growth, nearly double digit every single year, last 4 years looking very, very good, as well as the trailing 12-month, indicating 2024 likely to be another very strong year for this company. From a numerical perspective, more than doubled over the last 10 years, and whilst historically they had from 2014 to 2021 done some share buybacks, we have noticed given their recent merger, you'll see this come across a lot of their numbers, the shares outstanding has increased, but good to see on a trailing 12-month they have restarted buying back more shares. ROIC then, as we just mentioned, looking very, very good up until 22-23, nonetheless moving back in the right direction, 10% on a trailing 12-month. Now in terms of the margins, very strong every single year, even after the merger drop. We noticed 35% in 2022, increased to 40 on a trailing 12-month, and the free cash flow, again, similar to some other companies we've reviewed today, S&P Global is a free cash flow machine. Net debt to EBITDA also looking very good at 1.5 on a trailing 12-month and expected to come down over the next 12. No surprises why we did get that very safe dividend score. Now our intrinsic value at $533 is significantly lower than Wall Street. Theirs is $590 with upside of 15%, and we do believe this to be maybe one of the higher quality stocks that we are looking at today. At 10%, you would have to wait for $480. At 5%, around $506. So in today's episode, we believe S&P Global is trading around 0 to 5% at a margin of safety. Some people, they believe a very high quality company can be bought at a premium or in fact at fair value. Give me your thoughts below, but as you can see, Wall Street on this one don't agree. They believe this company is only going to go even higher over the next year. As always, give us your thoughts below. We then move on to PepsiCo with a triple hold right across the board. No surprises, this company has been coming down towards its 52-week lows after the appointment of RFK as HHS. We see another yield above 3%, 3.35, a forward P just below 20. Over the last year, down 4%. Over the last 10 years, up around 61, as we can see, all-time highs more than a year ago at just under $200, and they do anticipate growth every single quarter over the next year, 100% historical forecasting accuracy, with growth anticipated, lowering the forward PE over the next full year to 18.75. Nice to see another very safe dividend score at 93, double severe undervaluation, with a nice high single-digit increase in February this year at 7.1%. In terms of the metric, the increase is shown here. Pretty much recession sales were flat, but again that is above the average, and negative 35% recession return outperforming the S&P. We also noticed some very nice historical increases, 11% on average over the last 20, with 51 years of consecutively increasing the dividend, similar to S&P, a fairly new dividend king. Now on the forward PE, over the last 12 months, nearly every single month in fact, we do see severe undervaluation. One thing to note though, the gap is only getting bigger over the last few months, meaning this is becoming more and more undervalued. We also notice on both essentially models here showing very large signs of undervaluation, the yield significantly higher than the 5-year, the forward P of 19 significantly lower than 24. In fact, both are at stages that they're coming up to the massive COVID spikes that we saw on both yield as well as PE, and we notice it is coming around to be in line with consumer staples sector overall. We then move on to the free cash flow payout. Similar to Coca-Cola, it has been getting a little bit above the maximum we want to see. Nice to report though, over the next 12 months, coming in line at the 70% point that we do target at the upper end. Free cash flow, very, very inconsistent, pretty much the theme across today's episode, but good to see, massive jump anticipated over the next 12. Sales growth, very inconsistent again, starting to sound like a broken track record, but over the last few years has looked very strong, 0% on a trailing 12 month, possibly indicating very minimal growth in 2024. And from a numerical perspective, we can see around 40% growth from 2014 to 2023. They've also done some share buybacks, but very inconsistently, so not too much to discuss for PepsiCo for that metric. ROIC, very consistent, again, pretty much similar to Coca-Cola, and because we have reviewed both of these today, you can go across the video if you do want to compare to see which ones, in terms of the metrics, do look stronger. In terms of margins, pretty much straddling around the 16%, which is good to note, but unfortunately, we don't get to see any operating efficiency, and the free cash flow margin above 7% nearly every single year, so no worries whatsoever. In terms of net debt to EBITDA, since the highs of 2.66 in 2020, it has started to come down every single year and looking likely to come further over the next 12 months, which is why we did see that very safe dividend score. Now our intrinsic value, again similar to the previous company, it is lower than Wall Street and their forecast of 185. They see upside of 14%. For us right now, when we run it through the MOS, we believe if you are looking at a 10% margin of safety, you would have to wait for 155. So in today's episode, you are getting 5%. As we said, Wall Street though, still looking bullish. Give us your thoughts, buy, hold, or sell. We then move on to Target, that was plummeting after essentially reporting its very poor earnings just last week. Now trading at its 52-week low with a double buy and a hold from Quant. A nice forward yield of 3.6%, a forward PE just above 14. Now over the last year, it is down around 4.5%, but as we can see, just over the last week, it is down nearly 20%. And if you've been a longer term shareholder, you would be up 69%, although we do note it hasn't come past its all-time highs more than 3 years ago at $261, now trading in fact less than half of that price. In terms of growth moving forwards, well, 3 of the next 4 quarters they are anticipating in the green. However, do notice that very large drop that we talked about in their Q3 earnings, giving them ultimately a 50% track record. Now, if you believe they will hit their next full annual accounts earnings per share estimate, forward PE will come down to 13.4. Nice to see a safe score on the dividend at 80, a double severe undervaluation signal, and similar to some companies today, a very, very poor increase of 1.8%. When we take a look at the last recession, we'll increase the dividend, pretty much flat sales, and marginally trailed the S&P, negative 61. Good to see though, on a historical basis, this is a company that has been increasing those dividends at a double-digit rate, and again, very similar, like a few of the companies today, a new Dividend King status was obtained just over the last few years. In terms of the valuation based on the forward PE, we now see this severely below the blue tunnel, indicating that undervaluation. And when we do compare both yield as well as the forward PE, by now you'll understand how we identify this. These are giving some very, very large undervaluation signals and severely below the consumer staples, so Target is trading at a massive discount to the overall sector. In terms of the free cash flow payout, below 40% is what we want. We see a little bit higher in 2024 and expect it to be there or thereabouts over the next 12 months. In terms of free cash flow, pretty much every single company we've looked at in terms of Dividend Kings, fairly inconsistent, but it has doubled from 2015 to 2024, and a marginal increase is anticipated over the next 12 months. In terms of sales growth, nearly every year pretty much just keeping up in line with inflation, although some years very strong and 2 of the last 10, including 2024, have been negative. Nonetheless, we see around 50% growth over the last 10 years, and maybe the first company we have seen today that has been doing a significant amount of share buybacks over the last 10 years. In terms of ROIC, no complaints like every single one we have looked at today, looking very good, above the 17% that we want to see for consumer retailers, clocking in pretty much at that on the trailing 12 month. Now, operating margin is something that we would like to see better, but when we compare this to the overall sector, margins across consumer retailers aren't that high, so we have no complaints with this, but maybe something just to keep an eye on, and the comments that we had for the operating side pretty much reflected on the free cash flow margin. Finally, the net debt to EBITDA below 3 is what we want and what we get. 1.75 in 2024, there or thereabouts over the next 12 months, so no real worries at this point in time in terms of the dividend safety and balance sheet strength. Now let's get to our intrinsic value, $155. Now for those that want to see a more in-depth dive of this company, looking at their earnings as well, we did take a look not too long ago. When we run it through the MOS, we're at 10%, a buy at 140, at 15% around 132, and in today's episode, we see near enough a 20% margin of safety at $124. Now, when we reviewed this just last week, we didn't have the updated Wall Street target price. They have lowered it now to $150. Nonetheless, still 20% upside, 20% MOS for this Dividend King. Give us your thoughts below, buy, hold, or sell. As always, if you have enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter. We are dropping a new edition tomorrow morning, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.